shift gears here and talk about what's going on in the current event in the economy and in the markets. So recently, Jason, if you notice that the Federal Reserve is quietly planning for an exit strategy from the bond buying program, and this reminds me of what happened after they rolled out QE1, because I believe they were talking about doing an exit strategy then, but instead they did QE2. So is it going to be a deja vu again, or are they really going to exit?
I don't think they're going to exit. They could attempt to cut things back, but it might backfire in a really bad way. But let's talk about first, before we get to that in the dollar, let's talk about the other countries first, because I think that's why in the G7, let's talk about Europe and let's talk about Japan, and how that's related to some of these other asset classes and why I think asset bubbles are being created. Okay, Europe is a disaster. Europe is a total disaster right now. The statistics are bad. The unemployment rate is very, very high, especially for men in our age demographic, Mo. And it just seems, they've done one thing that the Wall Street people, the Wall Street robots and the Keynesians have done, which is really unfair and it's completely inaccurate, is they talk about free market forces as an Austrian school economist, and they say this austerity case, right? But what they don't say is that the taxes in Europe are going up. Okay, that's not what the Austrian school and free market forces talk about. We don't want higher taxes, okay? If there was a market clearing thing with less government spending in Europe, right, you have to reduce taxes in. You have to incentivize the private sector with their capital and the people who are holding cash on the sidelines to start making investments to rebuild the private sector. And that's what Europe is not doing. Their taxes are too high. You have France, you have a socialist there, you have fascism and other crazy mixed model governments in Europe. And, Austrian school economics is being blamed there. The free market's being blamed there. Capitalism is being blamed there. And there's a lot of Wall Street people. There's one guy in particular. Your name is Mark Dow, writing articles and on Twitter. You're a top hedge fund manager who worked for the Treasury Department. I am calling you out. You are saying that the Austrian school wants higher taxes. Okay? That is completely inaccurate. Okay? If anyone knows Mark Dow, tell him that that's not what the Austrian school wants. The Austrian school never wants higher taxes on the private sector, okay? So what we have here, Mo, is a case where Europe is basically collapsing, okay? Europe is in a lot of dangerous, in the near term at least, Europe is in a lot more trouble than the U.S. because the U.S. can just print money, okay? You have Japan, who is also, we've talked about this for over a year now, right, Mo? We said when the yen was around 80, right, 80 yen to $1 US, we said that Japan is going to start rapidly devaluing their yen. And that's exactly because the Keynesians think that, all we have to do to fix the economy is to devalue our currency, and it'll boost the stock market, it'll get exports going back up, and it'll, it'll boost the exports and the trade. It'll allow us to run trade surplus. And this is just, it's working in the short term. It's working it looks good. Look how much this Japanese stock market has gone up, and all that's happened is the yen has gone down, but long term it's setting up for a lot more problems. And like I said, in Japan and in Europe, there was a lot of people who maybe were in cash or in bonds or other stuff, and there is a lot of flight capital heading back here to the U.S.
And also, if you look at the chart for the yen, last time we covered the yen, we did a podcast, I think the yen was a little bit below 90, and now it's above 100. It just broke resisted at 100, and there's not much resistance after that, so there's no reason for the yen to keep going higher. So the central bank in Japan is accomplishing their mission and devaluing the dollar, creating inflation and enhancing the export market. And if you look at the earnings like Toyota, they're having great earnings because of what the Central Bank of Japan are doing.
But those earnings, conversely, Mo, are being taken away from, Mercedes and BMW and those guys. So don't be surprised then if Europe starts to, start QE and start to devalue their currency too. It wouldn't surprise me. But the main beneficiary, for our listeners out there, the main beneficiary of all these currency wars and QE, and Japan is doing their quantitative easing and currency debasement now faster than the U.S. government is. Okay, Japan is, I believe they're, what, Mo, is it over $75 billion a month now? And their economy is nowhere near as large as the U.S., right?
They're doing $130 billion a month.
Oh, okay. Okay. So Japan is devaluing faster than anyone on the planet right now. And they say it's not to fight a currency war. They say it's just to fight deflation. But it's also propping up the dollar. Because to, short their own currency, to devalue the yen, they have to buy Japanese government bonds. They have to buy U.S. dollars. They have to buy U.S. treasuries. And that's why the dollar, one of the reasons why the dollar has so much support, besides the Japanese government helping prop it up, Japanese citizens then, who see that the inflation coming, they're moving their capital, which was in cash, which was in Japanese yen or in Japanese government bonds. They're starting to move that money into the Japanese stock market and out of Japan then, and into U.S. dividend stocks and things like this. So this is why I wanted to explain to our listeners how the yen, how all the asset classes are all correlated and things like that. This is very important. It all starts with the policy from the central banks, the policy from the central planners, Keynesian economics, and what it's doing to the asset classes, which is, in my opinion, we are in the early stages of a crack-up boom. There is a humongous, a lot of the fundamentals of the world economy are not improving, and yet asset prices keep going up and up and up, especially, dividend stocks. Okay, let's go asset class by asset class now, since we touched on the yen first, and let's take a look at some of these asset classes like stocks and bonds in depth. Okay, the stock market, Mo, the top performers in the stock market, guess the asset classes. Guess the sectors of the stock market that have been the top performers. And guess what they all have in common?
Well, I know one of them that's doing very well is a lot of the consumer staple companies like Johnson & Johnson.
Exactly.
They're doing very well.
Yep.
Coca-Cola, Walmart,
yep.
Companies that create stuff that people need every day.
Okay.
Those companies are doing very well.
Yes, and more importantly, Mo, like the consumer staples you said and stuff people need, those companies are also larger, they have earnings, and they pay a dividend. Okay, the top four, for our listeners out there, the top four performing sectors in this nominal bull market that Ben Bernanke and other central bankers and all this flight capital has financially engineered via liquidity, U.S. dollar pegs, quantitative easing, all these other things. The top four performing sectors in the stock market are healthcare, consumer staples, utilities, and oil and gas master limited partnerships. And the one thing that all these four sectors of the economy have in common, Mo, is they're all known for large dividend yields. Okay? And they're all benefiting, a lot of them are benefiting too, Mo, from the fact that the Fed has manipulated the interest rates and the large banks have with the over-the-counter derivatives market and the interest rate swaps. They've manipulated the interest rates artificially low, and these guys like utilities and other industries are borrowing capital at cheaper and cheaper costs. I think the utility industry, Mo, has never been able to borrow at this cheap in many, many decades. It's many, many decades. So we have a situation where the stock market, Mo, this is the first time in many, many decades too, I think since the 40s or 50s, where the stock market yields on stocks are higher than the yields in bonds.
And I think that's one of the reasons why the dividend stocks are doing very well, because the yield on the bond market are terrible. Like the 5-year, the bond yield is below 1%. For the 10-year, it's about 1.95. And if you look at the 30-year bond yield, it's about 3.1. And you can find better dividend yields out there compared to the bond yield, because they're terrible. You're getting very little return, and when you kick in inflation, you're getting negative.
But we know,
rate of return.
But exactly, Mo. Exactly. In real return, even with the dummy CPI, people are losing their principal in the bond market for a lot of bond plays. But in terms of the bond market, you look at the government bonds, and those things are being bought by central banks. The ECB is buying a humongous amount of their country's debt now. The Fed is backdoor bailing out European banks. The Fed is buying a massive amount of U.S. Treasuries. They're really when other countries are not propping up the U.S. dollar, the Fed is still a massive buyer. Japan is buying a humongous amount of Japanese government bonds because the private sector in Japan, private citizens and corporations, large pension funds in Japan are now starting to be net sellers. So what we have here, Mo, and the funny thing you mentioned about the yields in bonds, bonds have been in a bull market for over 30 years too, I believe. The bonds are in a bubble too. And let me outline why. Not only is there artificial buying by central banks, but all this money that's being printed, okay, and that hedge funds and other people can borrow with, especially with the yen. We didn't talk about this with the yen, but there was the yen carry trade, which allowed foreign speculators and hedge fund people to borrow from Japanese banks at really, really low interest rates. This policy that Japan has now with the QE, it is creating the global yen carry trade on steroids. You can borrow like millions and millions of dollars as a hedge fund manager at almost 0% and put it, in a U.S. dividend-paying stock, or put it in a European bond or a U.S. bond. So that's exactly what's happening. So all these QE programs are causing like global carry trades on steroids, and that's creating humongous inflation in the asset markets. But back to the bond market now. One of the crazy things out there, Mo, is that junk bonds, which the company could go bankrupt, they could not pay back any of the bond, right? The yields on those, and the junk bond market has only really been around since Michael Milken created it in the, I think, late 70s and early 80s. But the junk bond market has never had yields this low. Okay, I think the average yield for a junk bond with credit rating, meaning that the company could go bankrupt soon, is below 5%. It should never be below 5%, right? Because of credit risk, because the company could go bankrupt. So I think that just shows that people are getting such free money, right, that they don't care. They're chasing anything with yield. Is that what you see?
Yes. I see from the research I've been doing, a lot of them are going away from the bond market and going into the U.S. equity market. And it's the investors in this country and investors in Japan and even China. China is heavily invested in the real estate market in this country, which is also in a bubble, not as big as the bubble that we had prior to 2008, but we do have a small bubble forming in this country again in the real estate market. So China is also buying real estate here. So the trend is that a lot of them are going out of the bond market and into dividend stocks.
And also, Mo, that's happening slower out of the bond market, in my opinion, and into stocks. But what is happening faster, Mo, is people are leaving cash, because they haven't gotten a return for years. So people are leaving money markets. There was people, 40, 50% cash after 2008, 2009, who held lots and lots of cash, not bullion cash, but, paper fiat money or money market funds or something like that. Lots of cash for, the last 4 or 5 years. And they haven't made any return, and they've seen, the markets and dividends and stuff like that. And now they're going to start chasing yield. So this is, and by no means, for the record, do I see a stock market crash? I don't, because any hint of a crash, there's a little bit of a crash. I mean, there's nothing out there to stop the Fed from going in and announcing that they're going to expand the balance sheet, because, it looks, according to the Federal Reserve statistics, their CPI and those things, that there is no inflation. And their models are telling them that there is no inflation, that deflation is the main threat right now. So if the stock market were to have, say, a 10 or 15% correction, the Fed's going to go and expand the balance sheet further, and that's going to bounce the stock market much higher, in my opinion. So I think stocks are going to continue to go higher. I don't see that really being a fundamental reasons, though, because in terms of revenue growth, they're small companies, Mo, that are growing their revenue, small, medium-sized ones that are growing their revenue really nice, but they're not getting the valuations. In a bull market, if this was a real non-artificial bull market, Mo, that was based on, real fundamentals, wouldn't the faster growing, like, small caps be getting a lot more better valuations and stuff like that? And that's not really happening.
No, it's not, and we can thank the Federal Reserve for that, because without their money printing, we would have another crash in the stock market, and they're basically artificially pumping the stock market and keeping it up so people can continue to believe that the economy is improving and that they're getting good returns in their investment. In nominal terms they are, but in real term, they're not.
Exactly, and the whole point of the wealth effect is that, it's supposed to make people feel wealthier, right? So they'll go out and spend more money, or they'll go out and take a loan out and
pay more taxes.
Yeah, pay more taxes, or go out and take a loan maybe from a bank and start a business, or go and rebuild their house or remodel their house or things like that. So I think we've done a good job talking about the stock market. Stock market's a really weird situation. We have not seen the the small and mid caps start to move up. Okay? In a bull market, if this was a real, like, fundamental bull market that was fundamentally driven, we would see the small and mid caps start to move. Better valuations on those stocks start to move higher. We have not seen that yet. We've only seen the yield plays move. With that being said, like I said, I think the stock market is going to move higher. I just think it's a lot of people, there's so much money being printed, there's so much money on the sidelines, so much money has been created liquidity-wise that people are chasing yield first. They're chasing the larger, sounder companies that are safer and pay a little bit of a yield. They're not looking for that rapid growth or anything like that, although there are some technology sectors that are doing pretty well with that. But in general in the stock market, I mean, there's been a lot of cost-cutting, Mo, since 2008, 2009. A lot of employees have been laid off. People have been hired back part-time. Companies are starting to move their manufacturing facilities back to the U.S. due to cheap oil, shale oil, and natural gas. Companies are switching to new software technologies and robotics and 3D printing and things and big data mining instead of using as many, actual people employed. They're using more computers and other technology. So those are things that the companies are doing, and then they're also borrowing. And this is the one thing I don't hear the deflationists and the take another shot at Mark Dow. He wrote a really long article talking about how there is no inflation, not even in asset prices. I think our listeners should go and read that. It was a couple days ago. I completely disagree with him because I've researched, Mo, over the last 4 or 5 months. I've researched the healthcare industry. I've researched the real estate industry, home builders, real estate investment trusts. I've researched banks. These guys are humongously benefiting from central bank policy right now on low interest rates. They are getting free money, essentially free money, to rebuild and buy assets and make mergers and acquisitions and leverage their balance sheets and grow that way. And they would not be able to have restored earnings and things like that but for the fact that interest rates have been manipulated artificially low. And he says that that's not inflationary, and I say it is because, they're getting free money and credit to rebuild themselves that they should not have been given, and there's industries that are getting industries and larger size companies, specific industries, due to Congress and other, policy decisions, and then okay, I just lost my train of thought there for a second, but there's specific industries and there's large-sized companies that have, assets to borrow against, and they're just benefiting from this when the small and medium-sized guy really can barely get along.
Yeah, and Congress and the U.S. government and Federal Reserve had made the playing field really uneven so that the big guys are getting all the free money and they're not worrying about any competition, and there's a lot of barrier to entry while the small and medium guys are pretty much suffering. And that's except for the technology sector, which is one of the most free market sector that we have out there.
Yeah.
But if you notice that these three industries that you mentioned, healthcare, real estate, and the financial industry, all three of these industries have massive government intervention going on right now. With the healthcare, you got Obamacare, and the healthcare industry is going to profit tremendously off of that. And then the real estate is, with the bailout for Freddie Mac and Fannie Mae, and the bailout for the, financial bank.
And the home builders, too, bailouts. They get tax credits from Congress, so they don't have to take a loss.
Yeah, that's true. That too. And they get subsidized too. First-time home buyers, they get subsidized as well. And then also you just mentioned the finance industry, which is getting free money from the Federal Reserve almost every day at the expense of the U.S. taxpayers. So all these three industries are doing well. That's only because the government has made the playing field really uneven and protected them while all the small and middle companies are struggling to survive and grow.
Yeah, and I would add, Mo, that a lot of the smaller firms in those industries that are getting preferential government treatment, some of them are not getting any government money and they're struggling. So it goes to show that the larger ones that are better connected, that are better lobbyists, better profits, that are in bed with the government, they're getting a lot more preferential treatment. They're getting the benefits of the inflation. As the Austrian school says, the people spend the inflation money first. Those are the people who benefit the most.
And if you look at the Austrian definition of inflation, that's when we have an expansion in the money supply, which is what we have now. And even though we don't have hyperinflation, we do have some inflation in this country. We actually have stagflation right now. So we have high unemployment and high inflation. So there's a lot of people out there that are saying there's no inflation. I think that because, the Federal Reserve printed all this money, and people have been screaming hyperinflation, and yet it never happened.
Well,
they're going out there and saying, well, there's no inflation, so we should stop talking about it.
Well, Mo, that's because a lot of the inflation, the money that has been printed, a lot of it has gone into asset prices first, and then it's been it's been exported due to the foreign exchange rate mechanism with trade partners. We've addressed this on many other podcasts about the currency wars. And it's left the country, so it's in the global value chain, in the global supply chain, and it's getting into consumer staples. It might have slowed down a little bit because China slowed down a little bit, so inflation might be slowing down a little bit, and commodity prices have taken a break. But looking at the asset classes, the stock market is definitely, the bubble's being reinflated. The bond market's been in a bubble for a long time. I don't know when it's going to burst, but Michael Pinto, I think, is calling for it in a couple years. He has a new book coming out. And David Stockman, I think, talked about that too, how the bond bubble could burst in his new book. And then, the real estate bubble, looks like the real estate bubble is being reinflated. There's a lot of money coming back into the real estate market, and it's all cash deals. Yes, the lending standards are tougher for people who actually want to buy homes and go live in them. So those flippers, people are not flipping them with no doc loans and no income, no job, no asset, ninja type people. But you are seeing the situation here where globally a lot of money has been printed so much that people in China, people in the Middle East, people from other developing world who have influence to the central banks and their governments, they're getting free money and they're coming here in the United States and they're paying all cash for real estate.
Yeah, and they're also, instead of flipping them, they're renting them out and becoming landlords. So we have a lot of people on Wall Street and China and other countries buying these homes and renting them out and becoming landlords instead of trying to flip them and make a quick profit.
Yeah, good point. And I mean, if you're getting free money, right, even if you take a little bit of a mortgage and you're renting out the property, I mean, your mortgage is going to be basically inflated away, and you're going to get to reinvest those premiums on the rental payment as long as your rental is above your interest payment on your mortgage.
Yes, and I've heard out there that, becoming a landlord is not really a profitable industry, so it kind of doesn't. We'll see how long it lasts when it come for them to realize that this is not working and they want to sell their real estate assets.
Yeah.
So it's going to be interesting to see what happens, because I've heard from many sources that becoming a landlord is not very profitable because of a lot of regulation and a lot of headache you have to deal with. And so
it depends. I'm a little bit more familiar with this than you, Mo. It depends on the state, and it depends on the county and municipal rules. Some states are more protective of tenants' rules, like you can't throw a tenant out for 6 months or a year, even if they don't pay rent. Some states and counties in certain states are like that. So real estate is local. So it just depends. Yeah. Real estate investing, it's a local business. You have to do more research into tax laws and those tenant protection laws and those types of things. Moving on to other asset classes, we've touched on the three of the main ones. We talked about stocks, talked about bonds, talked about real estate just now. The bubble's definitely being reinflated there. Cash, I think, is the one asset class long-term, besides bonds, I would not want to hold. I think people should definitely have stocks. People should definitely have exposure to stocks. People should definitely have exposure to commodities. It depends on your individual risk tolerance, how much capital you have, your objective goals, how long you want to invest for, those types of things. But the one asset class that really scares me is cash. I mean, it's good to have a certain amount of cash for a short period of time, just in case there is a market correction or something like that. But I wouldn't want to be holding U.S. dollars or definitely not Japanese yen for the next 5 to 10 years, holding them in a bank account.
And we're seeing a lot of people in Asia, in this country, are trading their cash and buying bullion after that big drop. So the trend seems to be going away from cash and more into dividend stocks, commodities, and gold and silver, physical gold and silver.
Yeah, well, to add to your point, Mo, the thing about commodities, and let's separate this. Let's talk about bullion. Let's talk about paper gold. We talked about the price smash, I think, in another podcast. But some of the Chinese trade data, we just got some of that coming out. China imported over 300 tons of physical gold last month. If you annualize that pace, if I don't know if they're going to end up buying 300 tons a month or not, but that is more than the 2,500 tons per year of annual gold mining supply. And it looks like the annual gold mining supply, Mo, is about to be cut back because a lot of the primary gold miners can't make money. So this is, and the paper price is just coming down. So I think there's really strong physical buying underneath this market, maybe a little bit below certain support levels here. We may see gold retest 1350, but I would be very surprised if it goes much lower, because then you start to see supply come offline very, very quickly, and that would be the bottom.
Yep. I agree. I think on average, from what my sources have been telling me, that if silver stays around the $23 to $24 level for an extended period of time, we will see a lot of silver miners either halt production or just shut down their production.
And hoard cash?
Or they could keep mining and just hoard the silver and gold that they mine until the price recovers. So,
if they have enough cash on the balance sheet, because if they're running the mine at cash flow negative, they're going to start burning through their cash reserves.
Yep. So that's what we're seeing out there for the gold and silver market as of now.
Okay, so let's talk then more about the other commodities then, because we've touched now on precious metals. Touched now a little. Listeners can go look at our other podcasts on precious metals, or they can email us more questions about, because we always talk about precious metals. So let's talk then about the other commodities. And why haven't the other commodities? We've seen inflation. Why hasn't a lot of this money then started to? I mean, to a certain extent, there is some money, there is some sector rotation into commodities, but it hasn't really happened on a drastic level that we're expecting. Is it just because too many people believe the government inflation statistics then?
Well, if you're talking about oil is tied to the economic activities. And what we have so far for the past few years is oil in a trading range between $110 and $80. And, once it bottomed at $80 and starts to go up, that's when, the Federal Reserve either do stimulus or some other country out there printing money, and the currency war kicks in, and the economic activity start to
we have a temporary
pick up.
boom?
A temporary boom, and then the oil prices start to go up. And then when oil prices goes up, that means higher energy costs for the companies out there that's making good and providing service for people. And so that means the economic activity will start to slow down, and they have to cut back. And then that's when the oil prices start to fall down. And if you think about what happened before 2008, when oil went all the way up to 140, the reason that happened is because the global economy, the activity was booming, and it was in a bubble. So oil was going up and higher and higher and higher. So that's why it went up to 140. And now with the economy, just dragging along, the prices of oil are just going in a range right now. It's going to continue to do that unless we have a big war in the Middle East or another black swan event of some sort.
Or massive more stimulus programs, Mo. But even then, you highlighted, without naming it, you mentioned the petro business cycle. You described it without actually saying the petro business cycle. We'll have the petro business cycle kick in again at a higher oil price, and then that'll crash the economy. But one of the things that, and this is why I don't believe that there's been a full recovery in all over the world. There is some developing growth in other emerging markets. It has slowed. And there is some sectors here in the U.S., especially technology, but there are some other sectors, like we outlined, that are getting free money, that are doing better than they were, say, in 2008, 2009. But one of the signs that I'm not seeing a sustained recovery is the copper price. We would see a higher copper price then if the recovery globally was more real. That is my opinion. Copper is one of the leading economic indicators. We would see
Dr. Copper.
Yes, exactly. We would see more demand for copper. So if there was a recovery, if there was global growth, if there was growth in this country or that country, we would start to see the copper price grow, and we're just not seeing that. In my opinion, if you look at the trade data for China, China has not really been doing that well. They've been growing at a slower pace. maybe after inflation, because they have a lot of higher inflation there, they're not growing at all. But China is still using, because they have more people who are moving into the middle class, they are still using more electricity and more energy. They're still eating more food, more vegetables, more proteins, and they're buying precious metals. So one of the I think we've talked about this to open up the year in 2013. I think what I said about the about the commodities bull market was I thought 2013 would signify a change in the commodities bull market, and things haven't proved out exactly the way I thought, because I thought precious metals would have a good year, and I thought food and energy and uranium and those types of ones would do very, very well. But those really none of the commodities have done very well, with the exception being U.S. natural gas, which was so low, Mo. At one point, it was below the cost of production for nearly 2 years. So there was a lot of supply that got shut off, and finally natural gas prices, after literally years and years of pain for the last 3 or 4 years, they bottomed around 2-ish or a little bit below 2, and now I think they're over 4 still. So natural gas has been surprisingly, in American prices, the top performer in the commodities market. The commodity sector is really, it's a cyclical bear, not a secular bear. I disagree with people who are saying it's a secular bear. I think, though, people have to be very, very careful which commodities they're invested in. I would not, because a lot of the growth is temporary, like Mo said, with central bank QE policy, and then it wears off. Like the best analogy is what a drug, getting high on heroin or something like that, or crack, and it wears off, and then the temporary boom stops. So I think people need to be, if you're going to buy copper, if you're going to buy iron ore or steel or those things, those are not long-term investments anymore in the environment I see. I don't mind holding oil dividend stocks, because those have some of the best yields anywhere. The oil producers like Shell and Total and Eni, the Italian one Eni, and Shell and those guys are paying really good dividends. And they're not getting good valuations because they're not master limited partnerships. They're not tax advantaged. The people are looking at commodity risk. People are pricing in much lower commodity prices. But the thing is, Mo, if we do have much lower commodity prices for pretty much across the board in almost every commodity, we're going to see large supply coming off the line, right? Because how many commodity we look at a lot of miners. How many commodity producers do you look at and see that are actually making good money right now? I don't see really any free cash flow.
Only a handful. Only a handful right now.
Yeah, I don't see, outside of the precious metal royalty and streaming model, and there's 4 companies, and everyone knows which ones I like. It's very, very public information which ones we like. I don't see many companies generating. This is copper companies, copper producers, coal producers, gold miners, silver miners, potash miners. Almost none of these guys are generating substantial free cash flow. They're just not. They're barely treading water. They might eke out a little profit here or there, but their costs are going up. Their metals or commodity price is going down, and they're cutting back on their growth program. They're trying to cut costs. I think some of these guys are trying to cut costs like 20-25% in a year. But they have not cut off supply yet, which I think is coming if prices stay this low or go lower.
Yeah, and the commodity sector is a very tough business to stay profitable over the long run, mainly because we have the volatility in the physical commodity market that they have to deal with on an ongoing basis. So
and also they're dealing with the mines, Mo. They're dealing with lower grades every year, almost lower grades, and then it takes more and more diesel or energy to move the rock to pull the lower grade ore out. So your costs are going up. Your grade, which is your margin, normally higher grade means higher margin. Your margin's going down. So it's not a good combination.
Yep. And from this, what I'm hoping to see in this industry is that they improve their technology so they can mine the commodity at a lower input cost, because the technology that they've been using is like 30, 50 years old. Not much change have been happening with the technology that they use to mine the rock or the ore. So with the higher input costs that's coming down the road, maybe that'll be a blessing in disguise because maybe there'll be more technology advances to reduce input costs. So we'll see what happens.
That would be good, Mo. That's a long-term solution. But, in the mining industry, people are slow to adapt those new technologies. What I would like to see, and I don't see enough of this, and especially the gold mining CEOs, the large gold mining ones did this, is they didn't focus on the quality of the project that they went out and bought. They went out and bought ounces in the ground. They didn't care about grades. They didn't care about CapEx. So they went and said, we just produced 8 million ounces of gold this year, or what? Barrick produced 7 or 8 million ounces of gold in 1 year at one point, right? So, we produced 7 million ounces of gold. We need to go buy a gold reserve project that will add at least that many ounces of gold reserves. And they didn't care about grade. They didn't care about how much money it would cost to put the mine into production. They didn't care about, good project economics, like a really high after-tax internal rate of return, which is a return on your invested capital. If you're getting 10% on $1 billion, right, on $1 billion mine, and you're only making 10%, and it's going to take you 5 years to build the mine, and you're going to have to take on a humongous amount of debt at really high interest rates, it's too risky to build the mine. It's too risky to build the mine. The industry is going to have to be more efficient. You don't need to build these large projects, and it's not smart to unless you have cash and you're not using debt.
Yeah, I agree. Yeah. So a lot of them are focusing on quantity, not quality mine. So
yeah, and it needs to be the exact opposite. It needs to be about which mines, which projects, whether they're they're near infrastructure and they're lower grade, but they're open pit. They're right near really great infrastructure. And, that'll generate a lot of free cash flow, or it's really high grade mine, but it's deep underground. So if it's higher CapEx, it better be really high grade. It's all about this industry. The one thing this industry has not done that it needs to do is focus on free cash flow. That is the name of the game. The value investors, the people who buy, Warren Buffett type dividend stocks and other value stocks. Only David Einhorn really is the only value investor I know who's bought any well-known value investor I know who's bought any mining stocks, gold mining stocks. And that's why the other guys won't touch it, because the industry has not proven that they know how to generate free cash flow consistently, and they need to show that they can do that. I believe they can do that in the future if they change things. Not right now. Obviously, right now they can't generate.
A lot of the management that we see in the mining sector are very short-term thinkers. They're doing whatever it takes just so they can keep their salary and keep their first-class airplane ride to wherever they need to go. Yeah. So a lot of them need to start thinking long-term and how to create value for the shareholders and how to, like you said, generate more free cash flow and focus on that rather than trying to keep their job and their salary and keep the light on.
Exactly. The former CEO of Barrick, and this guy was fired, he made $17 million last year, and the company lost money. Their earnings dropped drastically. He couldn't control costs. Costs spiked a lot. And the stock price was down more than 50%. So that's that guy should not be well rewarded then.
Yep, I think there's another gold company that where the shareholders are revolting against the CEO for getting a high pay for poor performance, but I forgot the name of the gold mining company.
Well, we have a whole list for listeners out there who are interested. We can probably send you a copy if you want to pay us a couple of bucks. Or you want to hire us for paid consulting work. We have a list of companies we like that are going to survive this and grow. We came up with a list for other paid consulting clients. So if people want a list of some of the companies that we really like that are going to actually survive this, they can contact us, and we can either work out a consulting session or maybe we'll send over the list for a certain specific price.
Yep. And that's pretty much wrapped up our podcast. So if anybody wants to listen to our other podcasts or check out our other articles, they can go to our www.wallstreetfrommainstreet.com. You can check us out on YouTube and Facebook and Twitter as well. So that's pretty much wrapped up the podcast. Jason, thank you for your time tonight.
Thank you, Mo, and hopefully our listeners get a lot out of this. Just expect, though, that there's going to be just because there's asset bubbles doesn't mean we think they're going to pop anytime soon, although the bond market's probably the most likely candidate to pop. But, the asset bubbles, that's the central banks and the politicians and all the other planners are committed to them. Wall Street loves them. Wall Street says they don't see an asset bubble, so it is what it is, guys. And we're just going to probably keep going higher. I think the stock market, Mo, has gone up. Or it hasn't had more. Sorry, it hasn't had more than a 5% correction at all in the last 177 straight days. That is insane.
Yeah, that's the Federal Reserve for you. Money printing.
Yep, and the plunge protection team buying futures contracts, S&P 500 futures contracts if there's any dip.
Yep. All right. Well, thank you, everybody. Thank you for listening.